Hi, this is Ron Janish. This time we're going to talk about the rule that covers trading that applies to any system that you use, really. One of the things that you're going to find is that markets don't do the same thing all the time, and that if you look at 10 different charts, you'll see 10 different things in terms of patterns. Now, one of the advantages of the median line technique is it has a tendency to give you the opportunity to take advantage of different situations. Here we see a market that is so incredibly strong. It went to the major FAR parallel and it went past the minor FAR parallel. And then it turned and reversed and went wild the other way, as you can see. And as prices went down, not only did they make the median line, they went right past it on the smaller median line. And if we look at the larger median line, we'll clearly be able to see let's see, it's over here and here. Okay, clearly be able to see that prices went down to the FAR parallel and turned again. Now that doesn't mean that every time prices are at or near a FAR parallel they're going to turn. uh, that's just like every time prices are at a median line they're not necessarily going to turn. Okay, um, so it just it just depends upon the situation. Now some people don't like that kind of uncertainty. They want something with far greater certainty. They want to have mechanical systems. So not a problem. You can deal with that kind of situation using the Andrews technique simply by taking the tools and turning them into something nice, easy, and mechanical. So instead of just drawing the median line here and here and saying, oh yeah, hey, when prices go up here you sell and take a ride the other way, and you draw another median line and take the ride the other way, uh, that can be a bit risky and a bit scary. So what we did was we came up with some techniques that one of them I call, for example, this is a cookie cutter mechanical type thing, the second time technique. And this would give this second time technique would give you an entry right over here, for example, and give you an exit down here. Now, quite frankly, prices went a lot further, and that's the way it goes. Because if you use something that's very mechanical with Andrews that gives you exact targets and exact time or exact time targets, that's what you're going to get. You're going to get out early in some situations or a little bit late. That's just the way it goes. So but the advantage is so for example, you had your entry here, your sell entry here, and your buyback entry, buyback over here, and this way you had the opportunity to participate in this down move with minimal risk because your stop is up here somewhere. Okay, let's see some other situations using the exact same mechanical parameter. Okay, so using the exact same mechanical parameter on this one here, this is currencies. Currency spread of Swissy over yen would have had you selling here with a stop right above here, exit there, buying here with a stop right below there, and exit in this area here. Once again, not getting the exact tops and bottoms, but still taking a good chunk out of it with a very defined risk. And it gives you the opportunity to take advantage of these different situations. Now, the catch is that it doesn't happen all the time. Okay, and can you use it on intraday charts? Yeah. Here's an example of the double thing, second thing I was talking about with the mechanical entry and exit. Here's your entry area at around 1305 and exit around 1317 within a day in the S&P, the 24-hour S&P. So using that exact same mechanical approach. Okay, and so in the course what we have is we have several of these because the market, quite frankly, isn't the same all the time. It doesn't give you the exact same patterns all the time. And some of them work out to your benefit nicely in terms of giving you the nice defined risk. But the catch is also that if you use those kind of techniques and approaches, you wind up missing out on some very long moves. And so here's an example. It would have gotten you in here, same simple mechanical approach. And your exit would have been at this value here. Now that would have meant in this particular case, with a risk of in this area here, uh, a reward of about 15%, and your risk would have been about 5%. Okay, so that's pretty good, having a 3-to-1 ratio there, but you would have missed out all this here. Now how you can take advantage of that is if you have an entry here, you can perhaps take off half your position and stay on until you have one of the other course signals that gets you out. But this is a simple mechanical model that uses time and price action in a very specific mechanical way with the Andrews indicators to get you buy and sell signals. All right. So this is how you use that law of alteration alteration. No, it's not alteration. I can't get the word this morning, but it's basically suggesting that the market's not the same all the time. Okay, that there are differences in what they do. So anyway, I hope that gives you a better and deeper, richer understanding. We will be having a seminar on North Shore of Oahu in June. Okay, it's a lovely place to go to. We have a nice deal with a condo outfit over there where just a few minutes walk from the beach you can get a condo for 100 something a night, and this is with all all amenities included in the condo. It's right on a golf course, and we don't make a nickel on it, by the way. We just give you the number and you bill direct. The And then we will also, in addition to that, probably have a seminar in July or August in San Diego. Okay, and that'll be by Lake Hodges in North County. So looking forward to seeing you there. Thank you for your time.